Up, guys, it's August 14, and we're going to go over the Walt Disney Company, their Q3 2022 earnings earnings numbers, and everything that we want to know about the stock moving forward. Okay, we own this stock for the portfolio, very happy with it. So let's get down to it. Okay, before we do, of course, please hit that like button, hit subscribe. Hopefully you learn something from these videos and we have some fun in the meantime. Okay, so when we're talking about the Walt Disney Company, everybody should know what the Walt Disney Company does. Otherwise, you pretty much live under here, a rock. And you don't want to be the person living under a rock. But of course, I don't think there's many of you out there that don't know what it does, or maybe have a very limited knowledge as to what it does. But of course, that's what I'm here for. We're going to go over the business segments and let you know exactly what it is they do. Okay, and we'll start with the parks and experiences and products segment. Okay, they have 12 parks worldwide and 14 if you count the Typhoon Lagoon and Blizzard Beach in Florida, which I think I went to Typhoon Lagoon as a kid when I was probably maybe 11, 12 years old. My parents took me there. Amazing place. I hope that it's better today. It probably is, given the way that they use technology to enhance parks. So Blizzard Beach, I've never heard of that one. I was looking it up. Looks pretty nice. So yeah, great A quality parts. Okay. Want to see Florida, California, Japan, France, and China. Those are where the parks are located. You're going to hear a great story from Florida and California. Just phenomenal numbers. Great story being told there. Japan's okay. France is better. France is the best of the international parks, seeing the faster of the recovery, and China's still a really negative kind of lag there. I'll put it in red here. China not doing well. And of course, that's because lockdowns. These parks have to close down, reopen. The Chinese government can't make up its mind as to what it wants to do. Keep people in, keep people out. So that's why. So the China exposure here, yeah, painful. But when we bought Disney stock, this was a switch from Wynn Resorts into Disney, okay? And Wynn Resorts makes 75% of its revenue from China, from 2 properties in China that are in Macau. So we went from a 75% exposure in a stock to about maybe a 5 to 10% exposure at the end of the day. So not too worried about the China exposure here. This is a well-diversified business when it comes to China exposure, okay? We have, of course, have the streaming, Disney Plus. Then we have Hotstar, which is Disney Plus Hotstar, which is kind of like the Bollywood Indian Disney Plus with Indian Premier League and a couple things here and there for sports there. Then we have Hulu, ESPN Plus, and of course we have our cruise liners, Magic, Wonder, Dream, Fantasy, and Wish. These are like grade A cruise lines. These are not for these are not for everybody. These are pretty pricey cruise liners to get on, and the experiences are first class. If you're a shareholder, go check out these videos of all these guys doing tours and giving you kind of like guided tours through the ships for their YouTube channels. Amazing stuff, okay? And then, of course, media and entertainment, the giant that it is, media and entertainment. We have Marvel, Star Wars, amazing franchises, Pixar, of course, the classic, animated series and animated movies, and then a little bit of a troublesome story with 20th Century Fox. We'll go into that in a little bit. But of course, we have the advertising, that is the media advertising arm, and that's advertising here. Like you see ESPN advertising DraftKings, which we own. That's a stock that we own. And then Duluth Trading Company being advertised here on ESPN as well. Disney gets paid for these advertisements, and that is part of the business. So good for us here, shareholders. Now let's go over the quarter. Okay, so pretty easy here. Part of my typo, I just noticed there was a typo here in the EPS numbers, but it's 99 cents, okay? So that's the expectation on EPS. It was 99 cents, but they turned in 109, and they beat the expectation by 10 cents. Revenue came in at $21.5 billion versus the expectation of $20.1, and they beat by about $490 million. It's about $500 million, guys. Excellent. Then there's other expectations here, but at the end of the day, the Disney Plus subscribers are what's important there. There's growth. That's something that Netflix cannot say and Disney can, that we have subscriber growth, and we're going to increase the price of that subscription, and we're probably going to see 0 to no churn on that subscriber. Churn, again, is a loss of customers, okay? So we're probably not going to see that. 152 million subscribers to Disney Plus alone. If you count all of the streaming services, we actually now have more subscribers than Netflix, okay? So that's great for us, and we'll keep growing that and blow Netflix out of the water, okay? And then the guidance was a little bit mixed. I call it mixed, not kind of like good to mix, not bad at all, but it was mostly maintained. Okay, there was a negative adjustment to a long-term guide in 2024 for paid Disney Plus subscribers. They expected 260 million subscribers by fiscal year 2024, but they adjusted that to 215 to 245 because of some changes with the Indian Premier League and Hotstar. So nothing too concerning there. The market not caring much about that at all. Now, over the metrics here that I put here on the side, I kind of skipped these for a while, but I want to talk about real quick about the forward PE, which I think is really nice for the company at this point at a 22 forward PE. Maybe with the changes on Friday and after reported, the forward PE is probably closer to 25 to 28, I would say, but still okay. This is a $221 billion business with a lot of growth ahead of it. So I'm totally fine. I'm not paying attention to the current PE because we're looking forward on the stock, and we have an expected sales growth of 38% in 2022, and that will continue through 2023. So very strong numbers and good subscriber growth. I think the stock is going to still take off, and it's going to go back to its glory days of $180, $200 a share. Okay, so let's move on here to the metrics, and some of these metrics here are Seeking Alpha metrics. We'll start with the price on Friday, 121.57, maybe a little bit less than that after some aftermarket action. But most analysts here, we have about 24 analysts being positive on the stock, overwhelmingly strong buy recommendations for those analysts. Okay, then we have 5 holds and 0 sells and strong sells. Average price target of 145, and you can see here the stock over 1 month. Healthy upside, just as good as it gets, guys, on a stock. Healthy upside there, okay? We were buying some in the 90s here in the hundreds, and we've lowered our cost basis to about I think it's 118, 119 per share, or for our cost basis on the stock that we own, about 119, I would say, on the high end, okay? Now, let's go over the conference call highlights and kind of go over a couple of segments here. This was a pretty tough thing to put together because you have to consider a lot of business segments and how they alone are doing, because this is such a big conglomerate of everything. So I kind of want to take it little by little and go over these numbers. Okay, so we have 26% year-over-year revenue growth for the company. That is amazing. And then we're talking about Disney Parks, and let me see here, stops here. Disney Parks and Experiences. So when we're talking about Disney Parks and Experiences, so you see that revenue's more than doubled year-over-year to $7.4 billion. More than double, okay, and beat the estimate of $6.75 billion. Just amazing numbers from the parks, okay. Operating income $2.18 billion versus $1.72. That's huge and impressive, and that's given the big expectations. The market already expected solid numbers from Disney, and they blew away the expectation for those solid numbers. Excellent. This is why the stock is acting, or has been acting in the last week the way it has, okay? And we've kind of seen a recovery of the stock from like the dumps back into a more respectable range, okay? Now, this is pretty interesting. The per capita guest spending in the parks was up 40%, not against lockdown levels, but pre-lockdown levels of 2019. So this is due to better technology, better crowd management, and better experiences overall. We'll talk a little bit about more of those experiences later, okay? We have 90% occupancy at domestic hotels. Amazing. And the demand for reservations are in excess of the available reservations at the park without the help of international travelers who spend more and stay longer, okay? So when these international travelers start coming back in droves, this number could be even better. The profitability could be even better because they just spend more and they stay longer, okay? We're talking about the UK, Europe, Chinese, Japanese, South Americans, everywhere. These guys stay longer and they spend more money because it's something they value more than your regular LA or Nevada or, Georgia or Florida type customer, okay? Now, the other flip side of that is that the international parks are operating at a loss, okay? This is a more difficult story than the domestic parks, okay? But Disney Paris is the exception to that, which is operating at above 2019 levels, just like the domestic U.S. parks. That's good news, okay? And then the cruise lines also still operating at a loss, but they're slowly recovering. If you look at the cruise lines, every single cruise line has been devastated through the lockdowns and through the hard times that were 2020 to 2021. But I think these cruise liners are definitely better than the rest, okay? They adhere to any kind of crowd. I think they're better for kids, they're better for adults, and you're getting first class experiences versus your Carnival or your Norwegian. I think that a Disney cruise is definitely more appealing than those guys, okay? Maybe if you're an adult that doesn't want to see kids, maybe, but at the same time, this is more geared towards families at the end of the day, okay? Now, Disney Media and Entertainment. Let's talk about this right here. So, a lot of stuff. Yeah, that's what we're going to talk about. Disney Media and Entertainment. So, revenue's up 11% year over year, and then operating income was down, though. So, operating income being down means that they're not profitable yet. So, Disney Plus not operating at profitability because they've been investing into making content, into expanding deals to bring movies and to bring series and hire actors. Okay, there's still a lot of investment going into that platform. I think for Disney Plus, if you think of the Star Wars series, you have this thing called the volume, amazing technology to make movies cheaper, but it takes a lot of front end investing to get this movie making technology out there. Okay, but in the long term, technologies like the volume will pay off. Okay, and then if you don't know what the volume is, go look it up. It's made by Lucasfilm, and it's gonna allow all these series to have a lower cost basis to produce. Okay. Now, also we're talking about Forex, foreign exchange rates. That's a difficulty that every company's been having that does business internationally. That it's losing about 20%. We talked about Palantir losing 20% of its cash that couldn't show its shareholders because of some Forex headwinds. Disney is no exception, guys. Okay, so the Disney subscriber growth, they blew away the expectations and they made up for that lack of profitability. Okay, and we think about Netflix, how Netflix used to purely trade on subscriber growth until it couldn't show subscriber growth. Disney here is still showing subscriber growth, so we can get a benefit that we're still increasing it, and profitability is a little bit more on the back burner than a Netflix would, because Netflix is losing subs or churning subs instead of creating them. Okay, now management is they said, hey, we're expecting them to still increase, okay, with the releases of She-Hulk, Andor, that's the one that I'm gonna watch for sure, and Hocus Pocus 2 for all your Halloween fans out there. For Hocus Pocus, that's an old movie of these witches and stuff like that, very popular back when I was a kid. Okay, maybe still today. Now we have ad revenues at ESPN Plus. I skipped this here. Profitability of Disney Plus by 2024. Okay, and then ad revenues at ESPN increased 40% year over year. That's because of the NBA Finals and some NHL games. Okay, and then strong pricing power. Okay, pricing power, again, something that we want to hear when inflation is a problem. Pricing power, and then the price increases for Disney Plus outlined right here. And you would think you expect churn, but the management says, probably not churning a lot of subscribers because of these price increases. I really like this Disney Plus with commercials for $7.99. I really like that option, but without commercials, $10.99. I think it's still a no-brainer to own this, especially if you're a Star Wars and Marvel fan and you need kind of that steady flow of content from those guys. I think it's still a great deal, probably better than Netflix at this point still. And then the last month, ESPN price increased by 42%. I think that's a different kind of customer that would watch those. I think in a bundle makes a lot more sense than just ESPN Plus by itself. Okay, and then talk about movie pipelines for the entertainment division. You have Avatar, which is going to be amazing. Black Panther. They received 170 million views in 24 hours. I mean, incredible. And then Strange World, which is another Pixar movie that's coming out. And the pipeline keeps getting better and better and better, with tons of Star Wars movies and shows for Disney Plus and tons of Marvel content out there. Typically, what you want to see when you want to know about the upcoming content, you want to go to YouTube and look at the D23 Expo, and you want to look at Comic-Con for Marvel, and you want to look at Star Wars Celebration for all the Star Wars content that's coming up. Those are probably all on YouTube out there for you to see. And then we have the sports viewership is steadily still increasing, okay, as Disney was responsible for 47% of all sports hours watched. Pretty impressive, okay, and that's a demographic of 18 to 49, probably mostly a male demographic, but it's still dominating the sports hours watched in the U.S., which is just simply amazing. Now, I want to go over my opinion of the business and kind of wrap this up, because I think the opinion is pretty simple here, okay? But I want to talk about what the stock has been doing in the action. And I'm saying, look, it's eventually going to stop trading based on Disney Plus and the sub editions, the subscriber editions, because that's what Netflix used to do. I don't think Disney Plus is going to do that anymore. I think the market wants profitability, but it needs to see huge subscriber growth in absence of that profitability, and Disney's doing that. Okay, so it's kind of checking both blocks, because we will be profitable in a certain amount of time, but we've already surpassed that Netflix kind of subscriber number. So I think that's excellent. Okay, now the market will begin to realize that this is not as comparable to Netflix. Okay, because the stock moves also because of pin action. You saw the stock move all the way from 180 to like $90. I think it was 90. I think it went as low as 89 at some point, maybe in an intraday low, went down to 89. And this is because of Netflix. Netflix started churning subscribers like crazy. And the market said, well, anything that's subscription-based streaming is dead. It's a pandemic play. You got to get rid of those shares and put yourself in a bank or in an oil stock. And I thought that was ridiculous, because Disney Plus, I don't think is as comparable to Netflix as the market makes it seem. I think the market will realize that in the future, okay? I think the stock easily owned under 120 per share. Easy buy. Free money. I mean, think about the stock trading in the low 90s, mid 90s. Every time it goes under 100, it's just kind of just throw everything at it. Everything, okay? And especially with the kind of company it is and the company that it's becoming, I think it's just a completely different company that it was 5 years ago. Just completely different night and day. Okay, now the bad part here is, actually, no, let's move on to that. So we're talking about intensely popular IP as intellectual property, like Star Wars and Marvel. I say Marvel, and I want to say Marvel because I own Marvel stock. That's a semiconductor. Nothing to do with Marvel Comics. Okay, and it builds these two IPs and intellectual properties. They build on endless storytelling possibilities. We're talking about Star Wars, endless storytelling possibilities, because Star Wars can span ages. I mean, hundreds, if not thousands of years through the timeline in the storytelling group at Lucasfilm. I mean, everybody who knows me knows I'm a huge Star Wars fan. The room that I'm speaking to you here is a Star Wars room. I'll post it on Instagram if anybody wants to see my Star Wars room on Instagram. I'll probably show it. I'll post it tonight so you guys can see. But I spent a lot of time with some help from my parents and my wife, of course, and we made it into a badass Star Wars room. I mean, just to say the least. Okay, so we have endless storytelling possibilities here, and then Marvel Comics take Star Wars and multiply it by 10 as far as storytelling possibilities with the multiverse theme that is developing lately in these movies and shows, right? So the multiverse is just a way of telling stories in different worlds that are just interconnected, which is just beautiful in my opinion, and a moneymaker. At the end of the day, that's what we worry about, okay? We'll be watching these movies, but we also watch how they make money for us investors, okay? Now, the balance sheet is quite weak, guys. We've got about $13 billion in cash and $54 billion in debt. Oh, that's painful. I usually would not invest in a company that has a balance sheet this weak, but that's because of the 20th Century Fox acquisition. You have to think about who made this acquisition. That was Bob Iger, the CEO before Bob Paycheck, Bob Paycheck. That's what I call him down here, Bob Paycheck, because I think that he's amazing. He's great. But his real name is Bob Chapek, okay? But I call him Bob Paycheck just to kind of hype him up, okay? Look at me on Twitter calling him Bob Paycheck, on Twitter, and just kind of try to hype this guy up. Now, ESPN Plus is a sneaky winner, guys. Sneaky winner. So we have in ESPN Plus, Formula One is the one that I'm sort of interested in at this moment, because it's a sport with a ton of growth in front of it. I recently became a fan of Formula One. I used to be back like in the 2000s, and I just dropped it off because Ferrari used to just win every race, and it just became not entertaining. But now Formula One is so different, and the rules have made it so competitive, and the races are just fun to watch. Now we have 3 races in the U.S., which will increase the popularity. One here in Las Vegas, which I will go to and wear my Palantir hat, because they're a sponsor of Ferrari, okay? But Formula One is very enticing, and I watch Formula One on ESPN Plus. But of course, the big one is the potential NFL Sunday ticket deal. And I kind of take this as a double-edged sword, because it's going to be expensive. The NFL, loves money more than anybody in this world, I think. And a deal for NFL Sunday Ticket is going to be the holy grail for Netflix, for Amazon, for Disney. There's going to be a ton of competition for that deal. Or if the NFL is smart, they'll kind of split those rights and charge bonuses and charge premiums for those kind of slices of streaming. So I think the NFL is going to make a killing on streaming moving forward. Okay, now price increases in streaming will also assist on the road to profitability and minimal churn. We talked about that. And then the Disney parks and experiences continue to implement better technology to allow better experiences and increase in revenues with less visitors. This is key. This is key for the business, guys. If you see something like this, let me show you guys Star Wars Galactic Star Cruiser. And you may not know about this. I'm surprised that not a lot of people know about Star Wars Galactic Star Cruiser, but this is the Star Wars Hotel in Florida. And this is not for your average Joe. Not by a long shot. I myself will not be going to it, even though I'm a huge Star Wars fan. And I will not go to this because you're talking about maybe $4,000 to $6,000 per person for a 2-day experience, but it is the ultimate Star Wars experience with technology and storytelling and imagery, attention to detail. These are the kinds of experiences that people will pay for, and this has been doing extremely well. If you don't know much about these kinds of experiences that are coming up, this is the future of theme parks and entertainment. Go take a look on YouTube. Go read some reviews and people who've been in it, and it's mostly positive. The only people who speak negatively are the people that have not gone to them because they can't afford it or will refuse to pay the price, kind of like me. I just refuse to pay a price like that. I'd rather just go to Disneyland or something and do that. Okay, now Bob Paycheck. We're talking about Bob Paycheck, excellent CEO. I think he's doing great. Watch his latest interviews on CNBC after the reported earnings. I think that this is a guy who is focused, who has a goal towards profitability, and has transformed parks and will continue to transform parks in a very positive way, even the international ones, and it's going to do a great job at it. Okay, now that's going to be it for today. Okay, that's a lot of information on Disney. I hope that you learned something from this stuff. Okay, if you guys have any questions, hit me up on Instagram, Twitter, also on the Discord chat. I'll leave the links below as usual. Peace out.